Good morning, everyone, and thank you for joining us for the latest instalment of our Navigating the Virus Crisis webinar series. Just as a reminder before we do start, a recording of this webinar will be sent to everyone who registered and will also be posted to YouTube if there is anything that you do miss. There is also a questions tab at the side of your screen. If you have any questions as we go, we will look to talk to some of those at the end. As always, this is of course general advice. It does not take into account your personal circumstances, and always read the PDF, which is available on our website before making any investment decisions. Outside of these webinars, I would note that we also produce regular content, which you can subscribe to. David provides a Monday morning snapshot, Bassanese Bites, and we have a weekly newsletter and posts on the Insights page on our website on some of the funds we're referring to today. I'm joined today, as usual, by our Chief Economist, David Bassanese. David will be providing his views on the economic environment and the changes that have occurred over the last fortnight and what is obviously quite a rapidly evolving situation. For those of you that haven't joined one of my previous webinars, Adam O'Connor is my name, and I'm a Director of Capital Markets here at BetaShares. And today I'll be talking to some relevant investment ideas for the market recovery and some of the funds that have been generating particular interest for us over the last few weeks. With that, David, I'll hand over to you to give us your lay of the land.
Thanks very much, Adam, and good to be with you all for yet another update in our series with regard to the economy and markets in this coronavirus pandemic. Let me get straight into it, just give you a quick update in terms of the situation with regard to the virus itself. Again, regular attendees to our webinar would have seen this in the past. I've just giving you an update there. Even in the day since I did this table, it's been updated. I can say there's about 3.7 million cases of the coronavirus now globally, and about 263,000 deaths according to the Johns Hopkins University as of this morning. So even that's a little bit out of date, obviously changing by the day. And what's still remarkable is that the ratio, if you divide the number of deaths by the number infected, you're still looking at a 7% death rate, at least according to the reported cases. Now, there's a lot of debate as to whether we're measuring everybody who's potentially been infected. Most experts suggest the death rate is a lot lower than 7%, which does mean suggests there's a lot that are going unrecorded. But that ratio is still, certainly high, and certainly at this stage, at least in terms of reported cases, up there with the SARS outbreak of 2003. So still quite a deadly virus, and that is still going around the world. And if you just look at the next slide, look, I guess a few weeks ago we had some good news in that the curve was flattening, and there was talk of economies being reopened. If you look at it globally, so this is the number of daily new cases being reported. And as you can see, look, the curve is flattened, but it hasn't started to fall away to zero in the way it has in some countries such as Australia. But so globally, we're still getting an uncomfortably high level of new cases each day. And if you actually look at it by country, just going to the next slide, if you look at if you look at where the virus was first evident in China and then in parts of Europe, such as Italy and Spain, look, that has started to drop away. The rate of daily cases, and this uses a 7-day moving average, has started to decline. But again, even in Italy, Spain, up until a few days ago, still uncomfortably high levels of cases being reported. And if you look at United States up there, still looking at something like 20 to 30,000 cases a day being reported. So yes, the curve is flattened, but the number of cases is still uncomfortably high. So America is debating, can it reopen its economy? Can different parts of the economy reopen? And we have seen in areas like New York and California, which had it first and the worst so far in the US, that they are looking to slowly reopen. But problem is cases are being reported elsewhere in the United States. So it's certainly, from a national point of view in the US, is still certainly not under control. and that debate, is raging at the moment in terms of how quickly things can reopen, and that's having share market implications. The reality that this thing isn't going away quickly, and countries can only reopen somewhat cautiously, is starting to wear on share markets, as I'll touch on in a bit later. So that's really the situation there. And as you can see, Australia, we've sort of done very well by global standards, and so yes, our number of daily cases is declining, has dropped away quite significantly, to a point where we are talking about reopening. The only, and again, it's still very gradual. So in schools, for example, we're still talking about schools being largely shut. Students going back 1 day a week at this stage in New South Wales and in Victoria. Restaurants and whatnot still not opening up at this point. And again, the challenge for Australia and even New Zealand to some extent is that we are heading into our winter months, where these type of influenzas are easier to spread than the summer months that the Northern Hemisphere is facing. So that's one of our challenges. But so far, so good in terms of Australia vis-a-vis other countries, as you can see from that slide. Just some information, in terms of the virus. Again, when we talk about the economic outlook, the market outlook, getting an understanding of the severity of this virus is critical. So, I'm spending a lot of my time reading a lot about, how serious this virus is, how different countries are dealing with it, just to get an idea as, will we be able to get on top of it quickly or not, or is it going to linger for a year or so? Because if that does that, that's then the worst case scenario. So again, one of the puzzling aspects of the virus is that the death rate in many countries is quite different. So as you can see here, in the UK, France, Italy, Spain, and again, this is a situation where the virus gets out of hand, it overruns your medical system, and you're not able to treat cases as effectively as you would like. And also, if it particularly gets in amongst the elderly parts of your population, as had been the case in Italy, Spain, again, and these are countries where extended families are quite prevalent. So grandparents living with, or either living with, or definitely having a lot of contact with their children and their grandchildren and whatnot. So that's helped to spread the infection in those countries. But so as you can see, UK, France, Italy, Spain, particularly high death rates. Even in US, it's still around 6%. At the other end of the spectrum, some of the countries in Asia which got on top of the virus quite quickly, they've been able to contain it, and through very good testing, basically testing, tracing, quarantining. Korea, Taiwan, they're kind of experts in this. They've dealt with the SARS virus and various other influenzas in the past. And Australia also up there in terms of having, we've contained the virus before it overran our hospital system, so the actual death rate has been quite low. So that again just shows you the spectrum of the incidence of this virus in different countries, and the problem that can arise if you do let it get out of hand and overrun your hospital system. What's also interesting, again, we're at this point now. Just going to the next slide. Now, there's a group in a University of Oxford, the BLAV, let me see if I can say it correctly, Blavatnik School of Government, University of Oxford. And they actually have come up with something called the Stringency Index, which looks at all the different measures that countries have done to contain the virus through, closing down public events, school closings, closing down cafes and restaurants, and they've created what's called this Stringency Index. So, up closer to 100 is very stringent, closer to 0 is not much at all. So, as you can see, in a number of different countries there, gradually over February and March and into April and May, conditions have tightened, but they've started to ease somewhat in some countries. So, if you look at the top chart there, China, look, overall restrictions are still in place, but they've certainly come off somewhat from where they were back in February. If you're looking at some other countries, I mean, really, they've come off a little bit. Korea has eased restrictions to some extent, but in the main, most countries still have fairly tight restrictions. And I guess the 2 points I'd make from this graph is that, A, the easing restrictions at this stage still remain quite gradual, in that overall the level of restrictions are still quite high, and it's uneven, in that countries are easing these restrictions at a different pace. So China's got ahead of everyone else because it had the virus earlier than most. Korea is starting to ease somewhat as well. But the problem, again, in terms of global growth and the global recovery, is that China can't rely on exports at the moment because everyone else is still shut down. So this uneven pace of easing these restrictions is going to, again, another argument to say that the recovery that we're going to get is not going to be V-shaped. It's going to be very patchy and uneven as countries unwind these restrictions to different degrees. And one of the debates also, again, one of the interesting aspects of the debate at the moment is different approaches. So I've just got a slide here on Sweden's performance, and I'm sure many of you are aware of this debate where Sweden hasn't imposed. Sorry, if we just flick back to the previous slide just to highlight that, if I may. If we just go back to the previous slide there, if you look at the bottom left corner, I've got Finland, Sweden and Norway. And as you can see in the red line there, its level of restrictions has been somewhat less than its neighbours, Finland and Norway in particular. Though nonetheless, even in Sweden over the last month or so, it has tightened up some of its restrictions, but it certainly overall has had fewer restrictions than some of its neighbours. And if we go to the next slide, and basically Sweden has adopted this strategy whereby will encourage social distancing, voluntarily, and encourage so they haven't shut down restaurants and cafes to the same extent. They have shut down major sporting events, so it's not just been complete laissez-faire. But as you can see, the death rate, Sweden has done what it's done, not with a view to thinking it can have lower deaths than anywhere else. It's basically essentially traded off having somewhat higher death, more cases of the virus, for two reasons. A, potentially to have less negative impact on the economy, but also on a view that, people are going to get this anyway, and some people are going to die anyway, but we're going to sort of bring it forward and build herd immunity. So others that are sort of closing things down and preventing the infection spreading, they'll probably end up getting a similar amount of cases and deaths, but over a more drawn out period. And Sweden argue that they can handle that up front because their healthcare system is quite good. Now, I'm not going to buy into the debate whether Sweden has done better than others. I mean, that's, there's a lot of trade-offs on that, but I just wanted to highlight that case because it is now part of the debate about how quickly countries should reopen. For example, Donald Trump overnight was asked, talking about reopening the US economy, and the argument was, are you accepting higher deaths potentially in the US as a result of this? And he says, well, maybe we'll have to see what happens. And so last week he was very critical of the Sweden experiment, and this and more recently seems to be somewhat open to it. And we're seeing a lot of pushback in the southern states in the US in particular about wanting to open up. And from a democratic point of view, it may well be that it's hard to sustain these restrictions when the infection rates decline, and then to be told you've got to keep these restrictions in place. Maybe ultimately what happens is you ease these restrictions. Then if the infection rates pick up again, you have to close back down. Just the nature of democratic systems is people won't accept these restrictions unless there is clear signs of the virus picking up. So, one reality is some country like the US, it may ease restrictions. It may get then a second wave of infections and may need to close down again. And that's politically maybe the only way you can kind of handle that. So I'm just throwing that out there as a possible scenario. But if you look at Sweden in terms of deaths, look at deaths and cases per capita, clearly higher than Norway, Finland, and Denmark. So its approach has resulted in more per capita. But whether or not there's been any upside in terms of the economy and whatnot is I guess the debate at the moment. Some parts of the economy have held up better, consumer spending and whatnot. Exports, Sweden's a very open economy, so exports have clearly been hurt. And it certainly hasn't been immune to a downturn. It's still facing quite a weak economy, as is the rest of Europe. Just going forward, in terms of the economic data, I mean, again, you just have to read the headlines to know that the data we're actually now going through the eye of the storm in terms of the worst economic data. The US now is bracing itself for quite horrendous economic data. I mean, the markets have said they've priced it in, but we'll wait and see. So here's another example of continuing claims. So that's like a rolling sum of weekly jobless claims. Up now around, it's actually off the charts there. If you squint your eyes and look at that blue line, it's got continuing claims, which is the total stock of people that have applied for unemployment insurance, is now at 18 million. And again, collectively over the last 6 weeks, the total new jobless claims has been 30 million. But continuing claims is another type of measure, is around about 18 million. And as you can see, well ahead of the peaks we had in past recessions in the US, actually off the charts in terms of the number of people applying for unemployment benefits. Now, the other line there is the unemployment rate. As you can see, in past recessions, the unemployment rate has got as high as around about 10%, usually been the worst case scenario, certainly over the last 50 years or so. The April employment report for the US will come out on Friday, and the markets are bracing themselves for an unemployment rate of, would you believe, 16%, and wait for it, a job loss of 22 million. 22 million jobs lost in the month of April is what the current market expectation is for that number when it comes out. In fact, we had overnight a sort of a precursor to that. It's called the ADP employment numbers, and that had 20 million job loss. And again, one of the reasons the market was off a little bit overnight, it's sort of like, it's just staggering under these body blows. It's still holding up, but it's certainly getting some body blows at the moment with the shutdowns. Just some other examples of that. US manufacturing, again, the latest number that came out slumped to about 35. So again, not as bad as we saw during the low of the GFC, but there's probably more weakness in that PMI indicator to come. And just looking at the sheer vertical drop really through March and April in that indicator. And markets are sort of saying, we can look through that, things can bounce back. And if you look at China, this sort of PMI indicator, once they moved out of lockdowns, did bounce back quite nicely, back up to around 50. But overall level of manufacturing in China is still quite weak. But again, the markets are sort of, there is a good chance that over the next few months that could bounce back if the US does reopen to some extent. But again, this leads to a debate I'll talk about in a minute, but I'll just go through some of these data points. The other one, just closer to home, Australia, this came out this week as well, ANZ job advertisements. So again, this is a monthly survey of job ads in newspapers and online, run by the ANZ. It's usually, a very good lead indicator of the health of the labour market. And, in April, we had a 50% decline in monthly job ads. So, in fact, given the nature of the shutdowns, you'd almost be surprised that anyone's posting job ads. So the fact that it's above zero is still, pretty remarkable. But look, it's just unbelievable what's happening. So there's 53% decline in job ads in April. Just going to the next slide. This is a weekly update from the Australian Bureau of Statistics, and they're surveying households and asking, what percent. There's a number of things they ask, but I guess the key one in terms of the economy is the percent of people saying they have a job versus don't have a job. And as you can see, since the start of March, that's progressively declined to something like 7.5% jobs lost. Well, 7.5% of the labour force having lost their jobs since early March. And again, we're looking at very weak labour market numbers over the next few months. Both the Treasury and the RBA are saying they expect the unemployment rate to hit at least 10%, and possibly, given the weakness of ANZ job ads and this survey here, it could actually be a little bit higher than that, given, notwithstanding the fact that you've got the job subsidy program in place where the government is basically paying employers to keep employers on the books. So that when we do finally reopen, those jobs can it's easier to restart because you've still got the in contact with your previous employees. But look, that's the situation in Australia, and you know, again, how long this goes on for, it's in the hands of the virus. But as I said, the good news, at least in Australia, is that we have contained it by a degree that is pretty good by global standards, and there is talk of reopening. But again, I think we're going to be disappointed at the speed with which things can reopen, and even if they do reopen, the speed with which businesses and consumers can go back to normal, given the lingering risks. And again, one of the concerns, again, this is one thing that caused the markets to rally last week. Just go to the next slide. One of these drugs to treat the coronavirus. I mean, this by a company called Gilead, and again, the markets rallied when this got basically official approval as a drug treatment, and the head of the National Institute of Allergy and Infectious Diseases, Dr. Anthony Fauci there, you've probably seen him on TV. I mean, he talked up these results, but actually, if you look at them, basically saying they've done a careful study of using this drug, and as you can see, the death rate if you use the drug for those, you know, those serious enough to need some drug treatment, the death rate of those that have taken the drug was 8% versus those that took a placebo was 11.6%. So clearly lower, and statistically significantly lower. So that's why they ended the trial and basically allowed everyone that was on the control, the placebo, to get access to this drug. But you know, to my mind, it's still pretty high. You're still talking about 8% of serious cases still dying getting this drug, and days to recovery if you don't die is 11 versus 15. So look, statistically significant, but hardly the silver bullet. This is something that still needs to be given with an intravenous drip. You still need to be hospitalized for several days. And so should the infection rate spike higher, it's still going to lead to, you know, it's not going to be a solution in terms of preventing overrun of the hospital system. So this wonder drug, which had the markets rallying last week, in reality, it's not much of a silver bullet. It's better than nothing, but it doesn't really, it's certainly not a vaccine, I think is an important point. Just to quickly conclude on some of the market outlooks, look, I think this is, where are we in terms of the market? First chart there is the S&P 500. As you can see, we had that big decline as lockdowns around the world took effect. We've had a rebound as the hopes of the lockdowns basically leading to a flattening of the curve and markets reopening having taken place. You know, the fastest rebound really since the late 1930s, after the fastest decline into a bear market really on record. But as you can see, over the last week or so, that rebound has started to flatten out somewhat, starting to peter out, and the market's sort of actually going into a sideways range. So I think, if anything, it's more vulnerable to correcting downwards. I mean, I still think we're in a bear market. I still think, if anything, this range is likely to break to the downside rather than the upside, given the weakness of the economy and the earnings outlook. If you look at the Australian market, again, our market is even more so, has flattened off in the last few weeks after an initial rebound, and just it's looking challenged to push up much higher from here. So we'll wait and see, but that's the sort of situation with the markets. After an initial furious, excited rally, over the last couple of weeks at least, things have started to peter out. Now, I won't spend a lot of time going through these numbers. They're a bit complicated, but I just wanted to share with you that really the situation with the market rebound that we've had, it's pushed up valuation. So if you look at it, the S&P declined by 33%, 34% between February and its low, and forward earnings actually declined by that amount since. And if you go forward, it's actually rebounded by the end of April by 30%, at the same time as earnings have declined by 12%. So the forward PE ratio, the valuation of the market, has gone from a high of 19 at the market peak back in February to now 20. So that is the challenge for the market, is that the PE ratio is even higher now than it was when the market was at a peak back in February. At the same time, the Australian market a little bit different, but valuations are still pretty high. But if you go to the next slide, and I've just penciled in some forecasts of earnings over the next few months. And again, we're still looking at a very further downgrade to the earnings outlook. So at the moment, the market is penciling in a 20% decline in earnings in calendar year 20 for the S&P, it's more likely, given the depth of the downturn, to be something like 30-odd%, which is what we saw in the previous few recessions. And if you pencil that in, the market, even at current levels, would be then trading at a PE ratio of about 24, which is something we haven't seen since the dot-com bubble. So that, to me, is the challenge for the market, is that even at current levels as earnings decline, and you try to look through this weakness, it means the market will need to trade at higher and higher valuations. And if you look at it, the last two recessions, again, in the US, they declined by 20% in 2001, and then they were flat in 2002. This is earnings. And then in 2008, they actually declined by 32%, which is where I get my 35% decline from, and then flat in 2009. So I'm actually being charitable, and I'm assuming a 20% rebound in growth in earnings in 2021 after 35% decline in 2020. But even with that, it's challenging for the market. The things to be wary of. What is different with this downturn? This is the challenge for analysts and investors, is that this is different in some respects. Firstly, it's a backwards recession in the sense that we're starting off at the worst point. So the shutdowns, we're going to see a massive spike in unemployment, and then things gradually get better. But maybe in 6 months' time, the unemployment rate is still, very, very high, and maybe close to the peak that we've seen in previous recessions. So how the market deals with that, do you focus on the rate of change? Things gradually getting better, even though the absolute level of activity is still very, very bad. I still think levels matter. So I think even though over the next 3 to 6 months, maybe things get better, they will still be very, very bad. And, it's sort of go from a depression condition to like a recession condition. But that's something. The other thing is we had a lot of monetary and fiscal stimulus up front. So it's been an undeserved recession, unlike the GFC, where a lot of stimulus was quite slow and begrudging. This time around, because, the recession has been forced upon us by shutdowns, governments and central banks have been less scared to basically stimulate growth. And so that's been a supportive factor. But again, I don't think it's going to be enough to outweigh the negatives. The other thing, and we're seeing that in the US at the moment, the lead sector of the bull market, the technology sector, particularly the FANG stocks, just so happen to be the ones least affected by the shutdown, because we're all working from home and whatnot. So if you look at the US market, it's holding up at the moment, holding up particularly with in the tech sector, whereas outside of the tech sector, the market is actually still quite weak. So that the tech sector is sort of camouflaging somewhat the weakness in the broader market. But even the tech sector, if you do have a continued weakness of the economy and advertising, demand declines, consumer spending declines, their earnings won't be immune as well. So even the tech sector, although it has relative resilience, I think their earnings won't be immune, as Apple and Amazon and whatnot have already flagged. The last point I'd leave you with is that again, yes, the valuations are quite high, but also bond yields are very low. So this is, if there is a reason that the market does hold up, even with very challenging valuations, is the fact that bond yields are very, very low. So I've just got that slide there of, bond at the moment, US 10-year bond yields are about 0.6%. So from a very long run perspective, it can actually justify, a very high valuation for the equity market. So at the moment we're about 20, and based on my numbers, it could actually get up to the levels we saw back in the late 1990s, 2000 of 25. But even then, that would be expensive, even given where bond yields are at the moment. So at the moment, arguably the market is rich. I kind of can't believe I'm saying it, but the PE of 20 with bond yield of 0.5%, it's off the charts. But from a very long run perspective, you could possibly argue that's justified, but anywhere near 25 wouldn't be justified. And I just leave you also with this. This is my big concern, is that the second wave. History suggests we'll get a second wave as restrictions are lifted. This is what happened in 1918, which is probably the closest example of what we're going through at the moment. And again, we don't have a vaccine. We don't have herd immunity in many countries. And I think the reality is that there is pressure to open up, even if that does mean a second wave, but then it would give the justification to possibly then need to reimpose restrictions, because that's the only way the population would accept these restrictions. So that may be the way we go. Just to conclude on the scenarios, as I said, regular attendees of these webinars would know these various scenarios, and it all comes down to how quickly we reopen up and what are the risks of a second wave when we do open up. And a W, I've added W as a possible scenario whereby you get very weak growth in Q2, you get a bounce back in Q3 with reopening, and I'm talking about the US in particular here, so the September quarter rebound. But then if you do get a second wave of infections as the US moves into winter, they need to tighten restrictions again, and you get growth slumping later in the year would be quite a negative. And then growth gradually then recovering in 2021 as hopefully a vaccine is developed. So WU type scenario still seems more likely to my mind. V shape is what the market is currently hoping for, and that's where the challenge is at the moment. And the worst case, of course, is an L, where we get these rolling shutdowns and no end in sight until such time as a vaccine arrives. So there are various scenarios. You definitely can't rule out L, but I'm still counting on a WU type scenario, but things better by 2021. But again, I think that's still too far away for the market to sort of blithely ignore what's happening in 2020. With that, I'll hand back to my colleague, Adam.
Thank you, David. So just moving on to some investment ideas and relevant ETFs from my end. In previous episodes, we've talked to some of the options we have listed here on the next slide for taking a more defensive position in portfolios. Now, the reason I mention these again is that they may still be relevant in the W-shaped recovery that David mentioned, for example. And if you aren't familiar with these funds, I would encourage you to visit our YouTube channel, where you can listen to some of our earlier webinars, or you can visit the fund webpage for each of these to get more information. We have also discussed why you would potentially look to higher quality global equities for longer and slower U-shaped recovery via QLTY, and also hybrids as an alternative to bank equities, where we've seen widespread dividend cuts over the course of the last 2 weeks. I'm going to take a different approach today, and I'm going to talk more to some of our core ideas for positioning portfolios for this market recovery, and some of the other funds we've seen increased interest in around that. I'm also going to revisit briefly socially responsible investing at the end. Funnily enough, we've actually had a question come through which said, at present, growth continues to dominate value. Do you see that changing as the world adjusts to a COVID-19 reality? Which is exactly what I want to talk to here in terms of positioning portfolios to growth over trying to buy value after this pullback, and why we still think investors might remain better placed by looking to an exposure like the NASDAQ 100 as a core global or a US equities allocation, which Dave has mentioned earlier, held up relatively well, rather than, say, looking to invest in areas in the market that have suffered the largest losses in order to try and capture the biggest rebound. And if we look back at the recent bull market, which has effectively just ended, that was characterized by the leadership of technology and the corresponding outperformance of growth relative to value that was mentioned in that question. Looking forward to the next cycle, whether or not it has already started or whether we do go on to retest our lows, we don't necessarily see this trend reversing yet, just because we've started in a new cycle. And this is for a couple of reasons. Firstly, the growth was and still remains structural, and that was very much driven by a digital revolution. Remembering earnings growth for the global technology sector massively outstripped the broader market over the course of the last decade. So it was very different to the tech bubble we saw in the late 90s and early 2000s. And these companies, they're very much still in the process of transforming the way that business is done and how consumers consume. So for us, it is hard to see this trend as having peaked in terms of a structural trend. And if anything, the nature of the crisis has only accelerated these trends. We've got companies that they're more likely to be forced to move to the cloud, for example, with remote working arrangements, and consumers are more likely to have transitioned to shopping online with no other alternative, as we've seen with Amazon struggling to keep up with their orders. Meanwhile, on the other side of that, cyclical industries are more traditional businesses by nature are more likely to have been significantly impacted by economic forces. And they may actually take more time to recover for many, even if they can recover at all. And so the other side of that, as we mentioned with growth dominating value, which amplifies that trend, is that bond yields were low, getting lower, and they remain at historic lows. And with an absence of growth anywhere else, we've seen that companies that are able to demonstrate the kind of growth that we're talking about here, they end up being well supported by the market. And again, this is a feature of the last bull market, which we don't necessarily see having changed as we enter into the next cycle. The other point we've made previously, but worth emphasizing once more, is simply the strength of the balance sheets of the major NASDAQ constituents, which obviously leaves them well placed to survive the economic downturn, and we believe emerge stronger than their more traditional competitors. I would also highlight that while there are obviously some very key differences between the index and the companies underlying, you can access many of these similar features that we're talking about in Australia via our Australian technology ETF, ATEC. So just turning to some of the funds that we've seen a real increase in interest in, and where we are seeing fund flows, which is a question we do regularly get asked by both advisors and retail investors. It's probably no surprise that we've seen a significant increase in flow towards our oil and energy ETFs in recent weeks. My colleague Alistair actually went through some of the dynamics currently at play in the oil market in our last webinar, and the considerations you'd need to make as an investor when looking at an oil futures-based product like OOO. If you are looking at using OOO, I would encourage you to listen to that and also to visit the insights section of our website, where we have a number of articles that cover the issue of contango in more depth and the considerations you need to make when investing in futures. What I want to talk about a bit more is our global energy companies ETF, ticker FUEL, as an alternative means of getting exposure to a recovery in the oil price and in the energy market more broadly. This ETF provides exposure to the largest energy companies globally outside of Australia. And importantly for our discussion here, it's around 45% what we consider the energy super majors. So they're companies like Chevron, Exxon, BP, Total, Shell, and the other two are ConocoPhillips and ENI. So they're considered the big six. And they're the companies that have historically dominated the energy market. And as you can see here, we've got a chart of the historical correlation between fuel and the front month Brent crude contract, which is obviously pretty close, given that these companies do have operating leverage to the oil price. So now I'm not here, certainly not here offering a view of whether or not we think the oil price has bottomed, but what we are saying is if you're of that view, and you're of the view that oil demand will recover from here and that the worst of the supply glut is behind us, then fuel may be a simpler alternative for you to get exposure to that view, and one with a number of its own unique structural tailwinds in that world. And what I mean by the unique tailwinds is this: the energy super majors who I mentioned dominated the energy market for a long time. They were hurt most by the emergence of small shale producers in the US over the last decade, who effectively have capped the price of oil, eroded their market share, and eroded their profits. Now, the current oil price has created a number of major problems for those smaller producers who are notoriously inefficient, and they're losing money at these prices. Now, they're basically unable to find people to lend to them, either bank lending or through the high yield market, and we're potentially seeing we're seeing potential for widespread bankruptcies across that entire industry. This is, on the other side, potentially a big positive for the much stronger big oil companies who still have very strong balance sheets and stand to benefit most from the demise of the US shale industry by both recapturing the market share they've lost previously and also being able to acquire some of the high quality assets in the shale basin at very cheap prices. So moving on, like energy, the other sector, I'm sure no one is surprised, to see investors looking towards is healthcare, and our global healthcare ETF, ticker drug. Firstly, healthcare and pharmaceuticals are historically considered a defensive industry. Drug sales and profits held up extremely well during the most recent global recession in 2009. But what's unique to this event that we're in now is obviously it's a global pandemic, and obviously there's universal pursuit of a vaccine and viable treatments to limit the mortality rate. So why ETFs have proven a popular vehicle for this kind of exposure is that it allows you to gain exposure to a broad basket of companies. So drug, for example, it includes AstraZeneca as one of its key holdings. AstraZeneca are working with Oxford on their vaccine, which is widely considered one of the most positive vaccines. Johnson & Johnson and Pfizer have started similar clinical trials, while Gilead, they're the makers of Remdesivir, and Novartis, the manufacturer of hydroxychloroquine, the Trump drug. So they have promising antiviral treatments. The other benefactors, which have probably been understated, are manufacturers of ventilators and test kits, like Roche, who last Sunday received emergency FDA approval to manufacture test kits, and United Health Group, who in the last month have gone from design phase to distribution of 3,000 lighter, less expensive ventilators across the US. One thing I should also mention about drug and fuel, like a number of our sector ETFs, they are currency hedged. The reason we do that is quite simple, in that it removes the added layer of currency risk that can affect your returns when you're investing in a specific equity sector. Finally, on relevant ETFs for the moment, with bank dividends being very topical, I just think it's worth highlighting our Australian Equity Income Fund, ticker EINC or EINC. This is one of our partnership funds with Legg Mason, and key point to note that it is actively managed by Martin Currie, making it unique in the ETP landscape relative to its peers in the space. And now why we think that it is important is when you're looking at long-only high-yield equities, we believe it is valuable to have an investment manager with a strategy that can be forward-looking with respect to the sustainability of a dividend, effectively to avoid dividend traps. And not only that, they can also ensure that the portfolio is diversified both at the stock, but importantly at the sector level. Because investors who depend on equities to meet their income needs, for them it's important to ensure that this income is diversified across different sections of the economy, and it's not just concentrated to banks, as many of the passive strategies inevitably are. And if we look at the underlying securities across the market, EINC, and then look at, say, the largest passive high yield ETF in the space, which we have here, you can see the exposure to the big four banks, and EINC actually has only 2 in the top 10. And it has around half the total exposure of the big four as, say, this high yield exposure, and significantly less even than the S&P ASX 200. So before I wrap up, the last thing I just want to circle back on is the conversation around ESG, or ethical investing. At the start of the year, ESG investing was set to become the next big area of growth, not only in ETF investing, but in the investment world more generally. Larry Fink, the CEO of BlackRock, he writes an annual letter to shareholders, and in this year's, it's extremely widely read. And in this year's letter, he stated that he believed that we were on the edge of a fundamental reshaping of finance. And what he meant by that was that capital globally is being seen to be reallocated to firms that are more environmentally and socially conscious in what they do, and are actively trying to minimize their impact on the environment. And a couple of good examples of this: Goldman Sachs last year made a blanket rule that they will no longer IPO companies with no female board representation. They also put a blanket ban on financing Arctic drilling operations. So that's what he's talking about when he says that we're on the edge of a reshaping of finance and capital allocation decisions. And I think that although we've seen this conversation take a bit of a backseat to more immediate issues in the current environment, that is very much a trend we expect to continue as we emerge into this next business cycle. And just to talk about the issue of performance, because more or less every investor survey that we see says that the primary roadblock for investors for utilising ESG investments in portfolios who would prefer to do so is the belief that they have to sacrifice returns. And that fact is simply not true. I have a chart here that shows global equities, the performance of ETHI versus the broad MSCI World ex-Australia benchmark. And we've spoken about quality as an investment factor, the growth component of NDQ, the investment rationale behind investing in drug. And if you look at the portfolio of ETHI, while it doesn't share the same index methodology as any of these funds, by nature of the screening process, removing energy, resources, material, you end up with a lot less cyclical and economically sensitive companies and more exposure to things like healthcare, to technology, and generally higher quality businesses. Now, we're not saying that ethical investing by nature will always outperform. In a world, in a cyclical recovery, you know, there is a strong chance that where material and energies perform stronger than these factors, that there will be underperformance. But our point is that you don't have to sacrifice the performance to have an ethical portfolio of stocks. In fact, the data suggests otherwise. Similar case domestically with FAIR relative to the S&P ASX 200, where that fund excludes the big four banks by virtue of their fossil fuel financing, in addition to the large materials and oil and gas stocks in the top 20. And you can see the long-term performance of FAIR's index relative to the S&P ASX 200 total return index there. So I will leave it at that. Those are the important funds I wanted to talk to. Just reverting back, some key things to consider. Obviously, investment risks, past performance not being a guarantee of future performance. Obviously, everything we spoke to is general advice, and we do recommend seeking professional financial advice before investing in any of the funds that we spoke to. Questions? I'll just have a quick look at my question screen here to see if I can see that we have any. I can't actually see any questions here. Just let me get on to our team so I can get a bit of a look through. Here we go. I have one here for you, David. Your views on the current US blame game towards China in respect of COVID and the related rhetoric or possibility of further trade restrictions arising, impact of those restrictions on the US, on AUZ resource-based and China-reliant economy.
Hello, can you hear me?
Yeah, are you there, Dave?
Yeah, great. Yeah, I can just wait until that's great.
Yeah, we've got one here on the US blame game towards China.
Yep. I got that. No worries. I'll okay, so great. just on that issue. I mean, look, I think this is a post coronavirus risk. I mean, again, we're talking about a recovery in 2021, but again, we'll have to wait and see who wins the US election coming up in November. But you know, again, I don't want to get into politics. I know some people like Donald Trump, some people don't. I guess in terms of just sheer market, in terms of the market, I mean, it's not helpful for the market were he to start to wage another, you know, campaign against China, whether you know justified or not. But I mean, I guess what he said last week was interesting, where you know I think just shooting from the hip again, sort of said. He thinks China was to blame for the virus and he might impose tariffs in retaliation. And obviously the markets didn't like to hear that. And again, it's just another thing to watch out for going forward. It would just add to the, we've got enough things to sort of worry about in terms of the virus itself. Potentially that leading to a reinstigation of the trade wars would be, very unhelpful in the current situation. So I think, obviously China have got a lot of explaining to do in terms of how this got out, and whether we were warned sufficiently or not. Whether the reaction is to impose tariffs, I don't think that's going to be helpful. So I don't really want to buy into that. But all I will say is that is the risk that Donald Trump does go down that path and try to divert attention, possibly from the problems that the US are having with the virus, which are quite significant because they haven't got it under control at this point.
Great. Probably another one for you, Dave, unemployment. The numbers are huge, but what percentage of these will very quickly return to work once factories reopen, etc., or maybe what's the anticipation for sticky unemployment?
Well, we'll get a good insight into that. Look, it all depends on the virus. So I mean, if it turns out that we can reopen up quickly and we don't get a second wave, things can go back to normal fairly quickly. In that sense, some optimists say this is like a natural disaster where you get a cyclone ravaging a town, and then things get back together pretty quickly. Now the only problem in that, this is a cyclone that doesn't last one day; it seems to last several months. So look, it is hard to sort of have a sense of how quickly we can get back as a result. But if we can open up quickly and there isn't a second wave, then nothing to suggest we couldn't get back. The only problem is that I think that we aren't going to be able to open up as quickly as we would like, given the lack of a vaccine and given the history suggesting that second waves are still quite likely, if not in Australia, because we can sort of close our borders somewhat more effectively than some other countries, then certainly in countries like the United States, where there's probably pockets of this virus still hanging around. So that is the big worry. We'll get a set. The RBA does put out their statement of monetary policy tomorrow, and in that they will have forecasts for unemployment next year. And so that'll be the best guess from the officials in terms of how quickly they think things can get back to normal. But I think what you'll find is the RBA will be forecasting the unemployment rate hitting 10% over the next few months, and then even next year holding at around 7%. So, the reality is that it's probably going to be some while before we get back down to 5% quickly, would be the best case scenario. Would be I wouldn't say the best case scenario, would be the base case scenario. The base case scenario would be, relatively slow return. But I hope that's wrong, but to be realistic, that's probably what we're looking at.
And Dave, one we get pretty frequently, expectations on AUD from here.
Look, I think AUD is very highly correlated with the sort of risk on risk off sentiment at the moment. If you track it versus the S&P, it's rebounded. Well, obviously it's slumped when equity markets slumped. It's rebounded when equity markets have rebounded. So if you're a bull and you think equity markets have seen their lows and are going to push on to new highs, I'd be a buyer of the Aussie dollar. If you think we're still in a bear market and we're going to retest our lows, then the Aussie dollar is going to head lower. Now, I'm more in the latter camp. I'm open-minded. Like I acknowledge interest rates are low and things are opening up. But I still think, if anything, the best case scenario is markets go sideways from here and wait for fundamentals to catch up, or equity markets go sideways. In which case, maybe the Aussie goes sideways from here as well. In the sort of low 60-cent range. But if we do retest those lows and the bear market reestablishes itself, then the Aussie could easily retest sub 60 cents. Worst case scenario, sub 55 cents. My base case would be a retest maybe around 57, 58 cents over the next 3 to 6 months, and then start to stabilise in line with equity markets. Great.
Just to finish, there's probably two here that I'll touch on that fall a little bit more in my wheelhouse. Sure. For those that, for the questions that we didn't answer directly or didn't have time to get to, we will send a response to you afterwards. One of the questions has been an update on hack and the role of cybersecurity in a post-COVID world, very much in line with what we were talking about with regards to the NASDAQ, growth over value and technology. Cybersecurity in particular, one of the things that we've seen is obviously unprecedented rise in home internet usage due to remote working arrangements, but more importantly, many traditional businesses are being forced to move online in a bid to adapt to their current environment. Offline processes like meetings, consultations, and are now on video conferencing platforms like Zoom. So with all of this, obviously becomes an inevitable uptick in malicious attacks and stress on their networks, which we think is a pretty significant tailwind for cybersecurity, with business sensitive data now having potential to be accessed by a far less secure personal computers and home Wi-Fi networks. So again, very much in line with the growth narrative of NASDAQ, but a sector that has its own unique tailwinds by virtue of the new remote workplace and the new normal that we're potentially looking like being in a post-COVID world. The other question was, is there a fund that can provide exposure to Asian-focused growth? We talk about growth in line with technology, and we do have our Asian Technology Tigers ETF, which has a significant allocation to many of the Chinese digital platforms like Alibaba, Tencent, Baidu, JD, and also has a number of the semiconductor manufacturers over there that provide the inputs for things like Apple iPhones. So I think that about wraps up our presentation. Again, as I mentioned at the start, we will have a recording of this sent out. It will be posted on YouTube, and we will be able to answer any questions that we didn't get to following on from this. So thanks again for joining us, and look forward to seeing you all here again in our next one.
Thanks a lot, everybody.